join us later. Okay, once again, welcome to this weekly series or session for guidance for final year accounting undergraduates, graduate accounting students, those on NYSC, those who have completed their NYSC, or even those who are awaiting their NYSC. We'll be discussing the topic, managing corporate bank accounts efficiently as an accountant. Managing corporate bank accounts efficiently as an accountant. As a new graduate or as a fresh graduate, or as a graduate that is understanding the ropes towards working as an experienced accountant. There are two scenarios when you get an accounting job. Number one, you are resuming in an organization that is already existing before you were employed. Such organization will have had a bank account. The second scenario is that you are resuming an organization that is at the startup phase. In other words, you are one of the first set of staff that are there to bet the organization. You are one of the pioneer staff, right, that are bringing the new organization to life. So those are the two scenarios. You are either employed in an organization that is already existing that has bank accounts, or you are employed in an organization that is at the startup phase that is preparing to have a bank account. Now, irrespective of the situation or irrespective of the scenario, some things are critical. Number one, now in resuming as an accountant in a startup organization or in an existing organization, there are some things you need to put right. There are some things you need to be sure of if given the right. And that will be appropriate documentation. Appropriate documentations concerning the existing bank accounts. There may be one bank account, there may be two bank accounts, there may be multiple bank accounts, there may be various bank accounts within the same bank, there may be various bank accounts in various banks or within the same bank. Irrespective of the scenario, your duty is to ensure that the documentations concerning those accounts are in place. And what are these documentations? Before an account is open or a set of accounts are open, there are documents that are submitted. These documents back what will have been filled out in the account opening forms. Whether the account opening forms are physical account opening forms or whether they are electronic account opening forms. Details like name of the organization, date of incorporation, incorporation number, website address, TIN, that is the tax identification number, the BVN of all the signatories to the accounts, and other similar documentation or information. So all of these are typical, and they are typical information, that is filled or submitted, that are filled in a bank account opening form, and that are backed by certain documentation. For some of these example of documents I've mentioned, you need to, accompany the submission of the form with the incorporation or registration certificate of the organization. You need to submit a copy of the tax identification number. For example, some may need you to submit evidence of tax clearance certificate. If they will necessitate the submission of copies of the passports or driver's license or national ID card or any standard means of identification acceptable by the bank or by the banks. You need to submit the appropriate board resolution or letter of request of opening of the account. In case of a one-man business or in partnership, a letter to the bank will suffice. A letter by the general partner or active matter to the bank will suffice, right? Documenting the resolution read by the partners to open the bank account. In the case of a company, a board resolution is sent to the bank evidencing the authorization of the MD or of the principal signatories to open the account and to run the account on behalf of the company or entity. Now, what we're saying here is that for all of those information we have filled in the account opening form, they are required to be backed. They are required to be backed by certain documents. So when you resume as an accountant in an entity that already has an account or that already has bank accounts, it is a duty to reconfirm that these documents, these supporting documents exist, and that these supporting documents correspond with the details or with the details of the information contained or filled in the account opening form or account opening forms. That is a duty. Where there are discrepancy in terms of the number of signatories, in terms of the name and date of the signatories, in terms of other identification details concerning those signatories, vis-a-vis, what are, or, the information filled on the form or information contained in the record of the bank, you need to rectify those information on resumption. This is for the situation where you are resumed in an organization that is already existing and that has bank account or bank accounts. The other scenario I illustrated is when you resume in an organization that is a startup. When an organization is at the startup phase, you may be the one, charged with the duty of getting the account opened. That will mean requesting or picking the physical account opening form or requesting for the electronic account opening form. That form will be filled in line with the approved signature, with the approved proposed signatories, or in line with the approved principal officers of the entity that are authorized to run the accounts. So ordinarily, of course, we're required to fill the detail, but those details are in line with identification or other information submitted by either the directors, by either the chief executive or that top executive of the organization. So those are the details that you fill, and this detail will be backed with all of those information I've mentioned ab initio when I referred to organizations that had already opened bank accounts before your employment or before your arrival. So all of these details will be filled in addition to the bank resolution authorizing the entity to open the account, and that resolution will also contain the nature, the classes of signatories who are authorized to run the account. So this is a case where you are an accountant at the startup phase of an entity, where you midwife the opening of the bank account. You ensure that all of the information required, let's say utility bill, evidencing the physical address of the entity, the tax clearance certificate as the case may be, and any other documentation required by the bank for account opening. So your duty is to secure all of this documentation that will have backed the content and detail filled or executed in the account opening form. When the account is open, of course, account number is assigned or account numbers are assigned. It's your duty to file this account opening documentation in the appropriate bank file. So let's take, for example, there are Bank A, Bank B, Bank C, and Bank D. So each of these banks, Bank A, B, C, D, and D, will have separate file. Such file will maintain the account opening form of these banks. The copies of the account opening form when filled. Please, I'm not talking about empty account opening form. I'm talking about filled account opening form. Before you submit the original copy to the bank, you should make photocopy for these account opening forms, which will be filed in each of the relevant folder or file of all the banks that an organization is opening accounts with. That folder should be filed and stored away safely. In your absence, in your non-availability, if there's a need to confirm certain information from the bank, whoever that is available or that is in charge or that is present or that is sent or authorized, goes to that folder, goes to the to the folder or goes to the file and open and confirm any relevant information that is requested. So that is that wing concerning account opening, securing the information, details, and appropriate alignment and sameness of the account opening information in your file with what exists in the bank. That is that concern account opening. Whether you are a startup accountant who is at the startup phase of an entity, or whether you are employed in an entity that already has bank account or bank accounts. So that is the position concerning that. Secondly, the other set of information very necessary and important is the operation or the running of a bank account proper. For lodgement into a bank account, of course, anyone can make lodgement into the account. Now, so for lodgement, as I said, an entity may have more than one bank account. An entity may have more than one bank account. There could be account for collection of sales. There could be account. There could be account for collection of sales. There could be account where interest on deposits or interest of placements are swept into. There could be account for collection of loans. There could be accounts for designated or dedicated purposes by an organization. Therefore, where customers are to make payments, the account number you have to communicate to such customers will be different from the account where interest is to be swept into or interest to be rolled over. So that is how you run an account. All accounts are not used for all purposes. All accounts ideally are not used for all purposes. So different accounts are maintained, and these different accounts, whether with the same bank or whether with different banks, have different account numbers. So these account numbers are communicated accordingly, according to the purpose for the payments, for the inflows, for the lodgements, for the collection or collections that are to be made into those accounts. That is what is required of you with respect to collection or deposit into account and how you manage such. The other wing of the operation are payment operations, bank account payment operations. For payments go in form of withdrawals, they go in form of transfers, they go in form of check issuances, and all other outflows that may be witnessed by an organization from its account. So it's your duty to ensure that your entity's payment transactions, that your entity transfer transaction, that your entity check issuance transactions, that your entity outflow transactions from its bank account are well managed. The appropriate and excellent management of these accounts require you to know the mandates to the account. Mandates mean the instruction or combination of instructions issued to a bank for them to obey debit instruction issued by an organization. The mandate of a bank account is the instruction or set of instructions issued or given by an entity to a bank concerning the account domicile with that bank on how debit instructions, that expression should be underlined, on how debit instructions concerning that account or those accounts should be followed. What do we mean by mandate? There could be two signatories to an account, the MD and the CFO. There could be three signatories, the MD, the COO, for example, and the CFO. There could be four signatories, there could be five signatories, and in that number, there are no limits to the number of signatories that can be found in an account. No limit to the number of signatories. But this is the issue. All of these signatories may be required to sign a check or may be required to electronic authorize an e-banking transaction. It is possible. It's also possible that these signatories are not required to authorize or sign off a withdrawal or a debit or a transfer transaction. In that case, we'll talk about combination of signatories. So there could be signatory A, there could be signatory B, there could be signatory C. So the mandate may be A and C are to sign for transactions that are 1 million naira and above. It could be B and C are to sign transactions that are 50,000 naira and below. I take it again. A and C to sign for transaction that are 1 million naira and above. It means that for any 1 million naira transaction, withdrawal or transfer that are to be made, signatories A and C must sign. The other mandate is B and C are to sign for transaction that are 50,000 naira and below. It means for any transaction that are 50,000 naira and below, B and C can sign. Therefore, if a check is to be written for a 75,000 naira transfer or withdrawal, that means that B and C cannot sign. Because 75,000 naira is above the threshold or limit of the 50,000 naira mandate given to the bank for such amount of transaction. Therefore, for a transaction of 75,000 naira, it will require the signatory of A and C. Therefore, in preparing your check as the accountant, or in authorizing the preparation of check as an accountant, that will mean you need signatory A and signatory C to sign. That will mean you need signatory A and signatory C to sign for a withdrawal of 75,000 naira. But if the withdrawal is of 15,000 naira, B and C can sign for such withdrawal. A and C as well can sign for such withdrawal. If you look at the instruction I've used as an illustration, or the combinations of instructions I've used as illustration, you notice that none of the three signatories, none of the persons, either as signatory A, B, or C, can sign a transaction alone. None of them can sign a transaction alone. Therefore, in operating the debit transaction, in authorizing, in administering the debit transaction of an entity, you have to ensure that every such debit transaction, whether they are check issuances, whether they are check withdrawal, whether they are transfer instruction, whether they are under form of a movement of money instruction, this kind of instruction must be in line with the mandate stated in the account opening form. The mandate is stated in the account opening form. We have to ensure that withdrawals or transfers are done exactly in line with the mandate. Along the line, it is possible that there may be a change of mandate. It is possible that there may be a change of mandate. What do I mean by change of mandate? Signatory C might have resigned. The MD might have been changed. For example, signatory might have resigned. The MD might have been changed. That will necessitate a change of signatory. You have to ensure that that follow-up of change of signatory is done to enable, seamless, uninterrupted use or transaction in an entity's bank account. So this is very, very key. Very, very key. When there is a change in the circumstance leading to a change in mandate, you have to ensure at all times that any transition in any nature, in any form, is reflected in the mandate in the bank account. And for a corporate organization, this will be backed by a board resolution. By a board resolution authorizing the substitution of signatory. That is very key. So this deals with, managing the debit transactions or withdrawals or transfer or movement of funds from an entity's account. The first part in this part of operation or management of an account are the lodgement, collection, or inflow side of the transaction, which we've spoken about. So we have discussed documentation, confirmation, and documentation of the appropriate information concerning the existence of a bank account, whether as a startup accountant or whether as an accountant that has been employed by an entity that is already operational and has bank accounts. We have also discussed the management, the coordination or running of the bank transaction in the account of an entity, whether they are inflow transaction or whether they are debit transactions. We have discussed that. Now we go to the third part of discussion. We go to the third part of discussion, which is bank accounts or bank statements reconciliation. Bank account or bank statement reconciliation. At the end of every month, at the end of every week, at the end of every day, it depends on the volume of transactions, that occur in the account of an entity. For you to decide the frequency of an entity, to decide the frequency of reconciliation that should be done. The frequency of reconciliation. Should an entity reconcile its bank balances every month? Should it reconcile its bank balances every week? Should it reconcile bank balances overnight, every day? It depends on the volume of transaction, the nature of the operating procedure of that organization, and other considerations. In the era of electronic banking, where an accountant is a signatory, where an accountant has certain rights to a bank account. For a bank account, you may have certain rights as an accountant, even though you are not a signatory. For e-banking application and e-banking account management, you could have certain authorization that does not qualify you as a signatory for withdrawal. Such authorization may be a viewing authorization. You can be created on the bank app of your organization, of the company you work for, or for an entity. That authorization may be allowing you to view transaction, but not giving you the sign-on right to transfer money out of the account. Right? So these things happen. You are given a view-only authorization where you are enabled to take note, to view all transactions that occur in the bank accounts of your organization or the company that you work for. With such authorization, there is no need of asking, should reconciliation be done weekly? No. Reconciliation should be done on as-you-go basis. At the end of close of business, you log on to view the closing balances, tracking all payments, all lodgements, and all withdrawal, taking note of all charges, whether the account maintenance fee, whether there are SMS alerts, whether there are other routine or bank charges, taking note of all of those. With a viewing right to an account, you agree with me that there will not be a need for bank reconciliation. Why is this so? With online real-time viewership rights on account, you notice any abnormality in terms of wrong debits, wrong credits, unpresented checks, uncredited checks. All of this you notice by your having a online real-time viewership rights to an account. So with that, you can always write to the bank if authorized, or you can always get the appropriate authorized staff to write to the bank to carry out an appropriate correction, or to exercise certain caution, or to reflect a needed adjustment in the account where errors have been made. This scenario arises where you have a viewing right to a bank account, where you have a viewing right. However, it is also possible that you may not have a viewing right. The viewing right may be for only the CFO and the MD. The viewing right may be for the head of account. The viewing right may be for other heads, even within the same finance or accounts department, but not you. But you are charged with ensuring that there is periodic bank statement reconciliation. In this situation, you are able to have an online real-time viewership of the status of balances and transaction in an organization's account. So in that case, based on the standard operating procedure of the organization, of the entity, of the company, of the institution, so you ensure you request for and get the bank statement, whether it is on a daily basis, on a weekly basis, and to do a comparison with your bank account in the accounting system of the company. I repeat, you compare and contrast the transactions and the balances in the bank statements you obtain with the bank account transaction and movement in the accounting system of the company. With that comparison, you note the differences, you note the abnormalities, and you coordinate the writing or communication of the bank to do the needful. It is also possible that an entity might have made a mistake or might have made a series of mistakes or error in his bank account, in his accounting system. In that case, you put up the necessary memo or put on the necessary instruction requesting for reversal or the passing of corrective entry to write or correct any abnormality. That is what you do concerning reconciliation. So when you have a viewing right, you don't wait for month-end reconciliation. No, not at all. You do it online real time. Online real time. You follow up. But when you do not have viewing rights, but you are tasked with the duty of ensuring bank reconciliation, following the standard operating procedure or the policy of the organization, you know whether to request for the bank statement daily, weekly, fortnightly, or monthly, and to carry out the appropriate reconciliation. That is what you do concerning bank reconciliation. Now move on to another stage of this. To the fourth stage. We have gone through confirmation of documentation and information contained in the bank account opening form we want to have in the bank. That is different. We have dealt with issue dealing with managing signatories, managing mandates, right, to an account. Who can sign? What combination can sign, and the likes. We have also dealt with managing the operation of the bank account concerning the credit entries into a bank account or lodgements, and also managing a bank account concerning the debit instructions concerning the bank account. Debit instruction covering withdrawal, check issuances, transfer, and all the rest. And just now, we've dealt with the need for bank reconciliation appropriately, depending on whether you have a viewing right or not, and depending on the policy or standard operating procedure of the entity. Now, let's move on into loan transactions. Loan transactions concerning your employer or the entity or the organization with a bank. When your entity takes a loan, you need to be careful. You need to be careful. When an entity takes a loan, as a new accountant, ordinarily for a big organization, you are not likely to be part of the team that negotiate the terms of a loan. Ordinarily, you are not. However, it is possible that an accountant for a small company, an SME, or a micro enterprise, where you are the all in all, even though you are a new or you are a startup accountant. In that case, you most likely will be part of the team that negotiates and discuss a possible facility transaction between a bank and your entity or your organization. In summary, after a loan deal is struck, an offer letter is given to an organization. That loan offer letter contains the name of the organization as the borrower or obligor, the loan amount or facility amount, the interest rate, the tenor, the lending fees. They are what we call lending fees. Before a loan is given, certain fees are charged by the bank. Sorry, I logged out. So as I said, there's some fees that are associated with lending, right? We call them lending fees. For these lending fees, right, there could be management fee, for example. There could be commitment fee. There could be management fee, commitment fee, facility enhancement fee, and the likes. All of these terms and conditions, let me summarize them. All of the terms and conditions concerning a loan are contained in the offer letter. So as an accountant, it's your duty to ensure that the draft offer letter that formed the basis of the discussion before the loan was finalized for offer. You need to ensure that the draft offer letter or indicative offer letter, because the way it works, offer letter is not issued before conclusions are made. Discussions are ongoing, and those discussions are premised on a tentative offer letter, on a draft offer letter, or an offer letter in principle. It is like a pro forma invoice, an offer letter issued as a guidance to guide the discussion. Then it may not be a formal, indicative offer letter. There may not be a formal draft offer letter. But this is the point. All of those conditions that form the basis of discussion before a loan is authorized should remain the same and should be contained in the ultimate or final offer letter that is issued to an organization. That's what we are saying. If the interest rate at the point of discussion was at 5%, management fee was 0.2% or 0.5% or 1%. Commitment fee was 1%. When the substantive offer letter comes out, when the substantive offer letter is signed, ensure that the terms contained in that final version or the substantive offer letter are the same with the terms of discussion before the letter was finalized. Now, after the offer letter must have been issued, you get the appropriate signatory, which will be the signatory to the bank account, to sign the offer letter. To sign the offer letter. When the offer letter is signed, based on the direction of your management, the offer letter is submitted, and the bank is requested to disburse the loan or the facility into the account or to make it available, right? After offer letter is signed, an account is not just created automatically. The bank will have to be notified. The offer letter is submitted, and the bank is notified to disburse or make the facility available for assessment by the organization. That is what is done. Now, as time goes on, in a month's time, or in some days, this loan or facility will attract interest. That is why you need to pay attention to the interest rate stipulated in the offer letter, number one. And number so as I was saying, depending on the kind of facility that is given to an organization, is it a term loan? Is it an overdraft? Is it an import finance facility? Is it a dollar line? Is it, a letter of credit? Is it a letter of credit, for example? Now, what is it? For example, whatever that may be, whatever the terms may be, you need to understand the kind of facility or lending that organization has gone to collect, because the structure of the lending determines how the interest rate drops. The structure of the lending determines how the interest rate, how the interest expense, right? The loan interest, how it drops. Depending on the cycle of the loan, if the interest rate or the interest expense charged by the bank drops, the interest on the loan drops every 30 days. Every 30 days from the date of booking of that loan, you have to confirm that the loan interest that drops into account is going to drop as a debit into the bank account of an organization. You have to ensure that the amount of debit that drops corresponds to the interest rate for that cycle of interest. For example, if a loan is at 5% per annum and that loan was booked on the 15th of a month, from the 15th of the month up to the 14th of the following month, that will be a 30-day anniversary for that loan. Therefore, a loan at 5% per annum, the proportion of the interest that should have dropped will be 35 all over 100 times the loan amount times 30 days over 365 days. 35 over 100 times the loan amount times 30 days over 365 days. That will give you the portion of the interest on the bank loan that should have dropped into the account of the organization. When you check where the debit in that account as loan charge or as interest on the loan is not the same with your calculation, you need to ask the bank to explain how that interest that was dropped into an entity's account was calculated or has been arrived at. You need to ask, right? Because there is need for sameness, giving an interest rate, giving a loan amount, and giving a cycle. That is what we are saying. So whenever there is a loan, whenever there is a credit facility taken by a bank, you have to be on top of a game as a first-time accountant to ensure that you track all of these things. You track all of these things, and you follow through, so as not to cause your employer to suffer excessive bank charges. So as not to cause your employer to suffer excessive bank charges. This is critical. This is critical, right? And you have to follow all of this in a timely manner. In a timely manner. As the month is ending, as the anniversary for interest expense to drop is arriving, you have your calculation well sorted out to compare with the debits that will drop into the bank account on which the loan or facility is granted. That is your duty. And where there is discrepancy or where there are discrepancies that after communicating to the bank, could not be explained, for example, or that does not tally, for example, right? Where that is the case, you have to write a letter to the bank demanding or requesting, right, that the needful be done, which is a reversal of the excess charges, right, or a correction of the appropriate entry, to correct an error that has been made. So let's take note. That is very, very critical. That is very, very critical. Now, to understand or master all of this thing about bank charges, I want to invite every one of you, for those of you in Nigeria, we have what to call Guide to Charges by Banks and Non-Bank Institutions. Guides to charges by banks and non-bank financial institutions. The current version of that guide, you can download it from CBN website. The current edition or version was the one that became effective January 1, 2020. It is issued by Central Bank of Nigeria. We had a 2004 version, 2013, 2017. Currently, we have that of 2020, January 1, 2020 became effective. In that guide to charges, you are going to see all the kind of charges that can be made by a bank. You are going to see all the kind of charges that can be made by a bank. You are going to see it. You are going to see them, rather, all the kind of charges. You are going to see the maximum rate that can be charged by any bank per time or per cycle, or depending on the nature of the transaction. So your mastery of that document, currently, the current version is over a 60-page document. Go through that document to understand the nature of charges or fees and other administrative costs, and even interest income or returns income on placement, right, that an entity is entitled to. That is what we are saying. So ensure you get that and be familiar with it. So that is that on this stream of what we are doing on managing corporate bank accounts efficiently as an accountant. When you resume, confirm that the account information and documentation is in order and that it tallies with what you have with the information in the file of your organization or entity employer in the record of the bank. That is the point. Where there are discrepancy, you take corrective action. Number two, understand the mandate for the running of a bank account. Who can sign what? What are the signatory combination? Can one person sign? Are two signatories to sign? What is the threshold of the amount that can be signed by two signatories or three signatories? Or are all signatories to sign for certain threshold of withdrawals or transfer or debit instruction? Number three, managing the banking operation of the account. We have credit or lodgement operations, and we have debit or withdrawal or transfer operations of a bank. You have to ensure that you give the appropriate account number for those concerned, where it is about lodgements, and that payments are made from the appropriate bank account. I mentioned that different accounts are used for different purposes. Some account could be for sales, some account could be for loan, some account could be for payment of salary and all of that. All of this you should be familiar with. No organization ordinarily has one bank account. There could be more than two accounts with a single bank. There could be many accounts with various banks. All of this will come within your ambit of management. Then we also discussed, number four, the issue of bank reconciliation. The need for timeous or timely bank reconciliation. That where you are an authorized viewer online of the bank accounts of an entity, you don't have to wait for month-end reconciliation. You don't have to wait for weekly reconciliation. Reconciliation is online and real time. As you view the status of transaction, movements, transfer, inflow and outflow and balances, you notice discrepancies in the account as compared to the instruction or to the nature of the kind of transaction that should occur at a point in time. For that purpose, you take the appropriate corrective next steps or measure. In conclusion, we discussed running the bank account of organization for which a loan or credit facility has been granted. You have to be familiar with every single thing we've discussed concerning terms of an offer letter, ensuring that the terms and conditions of a loan at the stage of discussion before the authorization are the same with the terms contained in a substantive offer letter. Let that not be a variation. And the terms and conditions like the amount, the tenor, interest rate, for example, the fees charged by a bank contained in an offer letter are understood by you. This will form the basis of all the charges that are interest expense that will be associated with that loan. And we close that by saying, take notes, get a mastery of the guide to charges by banks and non-banking institutions and non-bank financial institutions issued by the central bank. The current version is that issued and that became effective, rather the one that became effective from January 1, 2020. It contains all the lending fees that can be charged and the cap, the maximum amount that can be charged as lending fee. It contains interest you can earn on your deposit, right? What is negotiable, what is not negotiable, the condition under which you lose interest on certain deposits. It contains things concerning letter of credits, syndication of lending, e-transactions, and the rest of them. All of these are contained in that guide to charges by banks and non-bank financial institutions. So you are advised to go to the CBN website, download them, have them, and get familiar with them and arm yourself as you move ahead with your career. So we'll come to the end of this section. Thank you for staying in spite of the interruption. Thank you for staying in. And do we have any question? Do we have any question, Hope? Any question or contribution?
Yes, I have question.
Okay, please go ahead.
Okay, good evening. I want to ask, in an organization, we have been seeing whereby in terms of signatory, those that are signatory to the account, they choose mostly either the president or the vice president, and they choose the secretary and the treasurer. And some of them leave the financial secretary out from the game. So my concern was that how will you leave a financial secretary out from it when he's the one taking records of the finance and everything? How will he give report to the financial aspect when he's not signatory to the account? Why? What is the interest of the secretary being signatory to the account and the financial secretary not being granted such when he's the custodians of the finance of the organization? Because I joined an organization newly, I think it's a federal government initiative, and I was among those that they choose as a signatory. And definitely, I was the financial secretary. But because I was not, financial secretary was not listed on those that are supposed to be signatory, they pushed me to the treasurer based on the fact that the person trusted me and want me to be signatory to it. So I was like telling the person, calm down, the financial secretary is supposed to be the signatory and not the secretary. And he was telling me that is the order given. So that is why I'm concerned. Thank you.
Thank you. Now, if you, from what you mentioned, if this is an NGO, for example, the question is, what does the constitution of the NGO stipulate? What is contained in the constitution of the NGO, for example? Now, ordinarily, the constitution of an NGO or of most non-profit making organization will contain the offices, will contain the provisions concerning bank accounts, who can be signatories, the nature and rights or the nature of mandates that each or all of the signatories have. All of these will be contained. So if due process is followed accordingly, if due process is followed, the mandate stipulated in the constitution of an organization, the mandate stipulated in the constitution of an organization should be followed in appointing or complying with the mandates to be given to the bank on the run of an account. So for you, find out as the financial secretary, what does the constitution say? What does the constitution say? That is very critical. What does the constitution say? Right? That will be the guide. Now, where it is not like an NGO, there must be a resolution passed. There must be a resolution passed nominating or appointing those who should be signatory. There must be a resolution passed appointing or nominating those who should be signatory. So as soon as you can verify or vouch for that, then bring to the notice of the ESCO that the provision of the Constitution or the provision of the resolution passed concerning signatories should be respected. That is the way to go. And if you have external auditors, when the external auditors come for their interim audit or for their scoping for the first time, they should flag that as an exception. It is an irregularity. So that is that about that. Hope.
Hello, sir. Can you hear me?
Yeah, I can hear you. Yes.
What I'm saying is that I am not saying it's not their rule or their guide or it is a resolution passed. What I'm saying is that I cannot be a FinSec financial secretary and I am in charge of money, recording money aspect of what's going in and out. You get me? And I am not signatory to account. If anything happened at my back, what will I say?
Okay, your
Because I'm the
duty,
FinSec.
if you are not a signatory, that your FinSec does not demand that you have to be a signatory. All what you need, whenever all financial information you need to do your job, you request for it. All financial information you need to do your job, you request for it. If you need a bank statement, you request for it. You need the cash book or the accounts kept in the organization, you request for it. If you need the due payment booklet, you request for it. If you need the donation booklet, you request for it. Any information you need as a financial secretary, you have the right to request for it from any source to enable you to do your job. So what to be an offense is the prevention of you not being able to access or get the appropriate information. That is what will be the offense. That is what will be the offense. But if all the information is made available to you, then there's no problem. Everything is in line, meaning there is no inhibition for you to execute or do your job. Thank you. Okay.
Thank you, sir.
Okay, I want to thank you, Hope. Thank you, Ali, for being there. Thank you, all of you. So, bye for now.